Thinking about buying a home in Texas? The home buying process here has some unique steps you'll want to know. In this video series, I'm walking you through the entire process, from choosing the right neighborhood to closing on your dream home. Today, our topic is mortgages. Mortgage pre-approval. One of the biggest mistakes buyers make is assuming they know how much home they can afford based on online mortgage calculators or rough estimates. A pre-approval from a lender takes a deep dive into your income, debt, credit score, and financial history to give you a more realistic budget. This means you're shopping for homes in the right price range and avoiding the heartbreak of falling in love with a house that's outside your budget. When you find the one, you don't want to waste your time scrambling to get your financing in order. If we go house hunting on a weekend, most often I'm writing up the offer on Sunday afternoon or Sunday evening, when most lenders aren't working. Having the pre-approval ready to go means that we can submit our offer before the other buyers submit theirs Monday morning. A pre-approval shows most of the heavy lifting is already done, so when you submit an offer, you can move quickly and confidently. Some sellers won't even allow showings to buyers who aren't pre-approved. So how do you get pre-approved? It's actually pretty simple. You'll need to, number one, choose a lender. I can recommend great lenders. I always recommend using a local lender instead of an online company or large bank. 2. Provide financial documents like pay stubs, tax returns, and bank statements. These go directly to the lender and not to me. 3. Run a credit check to determine your loan eligibility. These items will help you get a pre-approval letter stating how much you're approved to borrow. This process typically takes a couple of days, but it's an essential step before seriously shopping for a home. Understanding your home financing options. Whether you're buying your first home, a second home, or an investment property, it's important to understand the different types of mortgages, how they compare to paying cash, and what kind of down payment and interest rates you can expect. I'll break it all down so you can make the smartest financial move. Mortgages versus paying cash. What's the difference? When buying a home, you have two main options: financing it with a mortgage or paying in cash. Here's what each option means for you. Paying cash for a home. If you have the funds available, paying cash means you own the home outright with no monthly mortgage payments, no lender fees or interest, a faster, smoother closing process. Sellers often prefer cash buyers because it eliminates financing risks, which can give you a negotiating advantage. Cash buyers can close faster, sometimes in as little as 2 to 3 days if everyone is in a hurry. However, there are rules and considerations when paying cash. The seller and title company will ask for proof of funds before agreeing to accept your offer to buy the house with cash. This is usually a letter from your accountant or banker, along with copies of bank statements. You don't have a lender to require an appraisal, but you may still want an appraisal to ensure you're not overpaying. Having your agent run a careful market analysis can help make sure that the numbers make sense. If you transfer large sums of money before closing, your funds must be sourced and documented to comply with federal regulations. You still need to budget for property taxes, insurance, and maintenance, since those expenses won't be escrowed like they are with a mortgage. Paying cash can be a great option, but it's important to weigh whether tying up a large amount of money in real estate is the right financial move for you. Your money might be better off in higher yield investments, and it's best to talk through with a financial advisor or accountant to determine which option is better. Paying cash can give you a feeling of security, knowing your primary home can never be taken away from you. Types of mortgages. For most buyers, a mortgage is the best way to finance a home, but not all loans are the same. Here's a breakdown of the most common types of mortgages. Conventional loans. When it comes to home loans, conventional loans are the most common type of mortgage. But what exactly are they, and how do they compare to other loan options? I'll break down everything you need to know about conventional loans, including who qualifies for one, how much do you need for a down payment, loan terms and mortgage insurance, pros and cons compared to other loan types. A conventional loan is a mortgage that is not backed by the government. Instead, it follows guidelines set by Fannie Mae and Freddie Mac, which are organizations that help keep the mortgage market stable. Unlike FHA, VA, or USDA loans, which are insured by the government, conventional loans are issued by private lenders like banks, credit unions, and mortgage companies. Because they don't have government backing, they often have stricter qualification requirements. To qualify for a conventional loan, you'll need to meet certain requirements, including credit score. A minimum credit score of 620 is typically required, but a higher score of 700 plus will get you a better interest rate. Stable income and employment history. Lenders will check your job history and income stability for the last 2+ years. Debt to income ratio. Ideally below 43%, meaning your total monthly debt payments, including the new mortgage, don't exceed 43% of your gross income. If you have good credit and a stable income, a conventional loan is one of the best mortgage options available. If you don't qualify for a conventional loan, an FHA loan may be a good alternative since it allows for a lower credit score and just 3.5% down. FHA loans. Designed for first-time homebuyers or those with a lower credit score, FHA loans offer a 3.5% down payment with a credit score of 580 plus, more lenient debt-to-income ratios, required mortgage insurance. FHA loans are great for those needing a lower upfront cost, but keep in mind that mortgage insurance stays on for the life of the loan unless you refinance. FHA loans are assumable, meaning that a new buyer can take on the existing loan from the seller. The buyer will then be responsible for the loan's original interest rate and terms. This can be very helpful in times like these because the previous mortgage often has a much lower interest rate than today's mortgage rates. A buyer will have to cover the difference between the original mortgage amount and the purchase price with cash for a second mortgage, which has sometimes presented as the problem with assumable mortgages. VA loans. If you are active duty military, a veteran, or an eligible spouse, you have access to one of the best home loan options available, the VA loan. This program was designed to make homeownership more affordable for those who have served our country. It comes with huge financial benefits that other loan types simply don't offer. A VA loan is a mortgage that's backed by the U.S. Department of Veteran Affairs and is available to military service members, veterans, and eligible spouses. Unlike conventional or FHA loans, VA loans come with major benefits, including 0% down payment, no need to save for a big down payment, no private mortgage insurance. This can save you hundreds of dollars per month compared to FHA or conventional loans. Competitive interest rates. VA loans often have lower rates than other loan types. Flexible credit requirements. Easier approval compared to other conventional loans. No loan limits for first-time VA borrowers. You can buy a home up to any price point as long as you qualify. A VA loan is one of the most powerful home financing options available, but not everyone qualifies. Let's go over eligibility requirements. To use a VA loan, you must meet one of these service requirements. Active duty military with at least 90 continuous days of service, veterans who have served 90 days during wartime or 181 days during peacetime, National Guard and reservists who have served at least 6 years of service or 90 days of active duty, surviving spouses. If your spouse died in service or from a service-related disability, you may be eligible. If you think you qualify, the next step is getting a certificate of eligibility. This is proof that you're eligible for a VA loan. Your lender can help you request this, or you can apply for it through the VA website. You'll still need to qualify financially. While credit requirements are flexible, lenders will still check your credit score, debt-to-income ratio, and income. One thing to note, you don't need to go through a specific VA lender. Any mortgage lender who offers VA loans can help you, so it's smart to shop around for the best terms and rates. Even though VA loans don't require a down payment or mortgage insurance, there are still some costs to be aware of. Funding fee, a one-time fee that helps keep the VA program running. It ranges from 1.25% to 3.3% of the loan amount, but can be waived for disabled veterans. Closing costs. Similar to other loans, VA buyers will pay for appraisals, title insurance, and lender fees. Property requirements. VA loans require specific home condition standards, so fixer-uppers may not qualify. The good news? Many sellers will cover closing costs for VA buyers, and some lenders allow you to roll the funding fee into the loan so you don't have to pay it upfront. Jumbo loans. Jumbo loans are for homes that exceed conventional loan limits, which in most of Texas is about $766,000 in 2024. These loans require higher credit scores, typically 700 plus, often need 10 to 20% down, and have stricter income and asset verification. If you're buying a luxury or high-end home, you'll likely need a jumbo loan. Primary residence versus second home financing. If you're buying a home to live in full-time, you'll get the best mortgage terms with lower down payment options and lower interest rates. But if you're buying a second home or vacation home, lenders see it as a higher risk, which means larger down payments, typically 10 to 20%, higher interest rates than primary loans, stricter debt-to-income requirements. For investment properties, requirements are even tougher. You may need 25% down or more, plus a strong credit profile. If you're thinking about buying a second home in the Lake Travis area, keep this in mind when budgeting for your purchase. There are creative lenders in the area who can use projected rental income, long-term or short-term, to potentially help you qualify for the investment home mortgage. Let me know if this is something you're interested in, and I'll connect you with the right people. Varying down payment amounts. One of the biggest myths is that you must put 20% down to buy a house, and that's not always the case. First-time buyers can qualify for lower down payments of 3 to 5% down. 10 to 15% down is a good middle ground that lowers your mortgage while keeping some savings. And 20% or more down helps you avoid mortgage insurance and reduces interest costs. Your down payment affects your monthly mortgage amount and loan options, so it's important to find the right balance for your financial situation. Lender rate buydowns, lowering your interest rate. Another tool buyers use to lower their monthly payments is a rate buydown, which means paying extra upfront to lower your mortgage interest rate. Permanent buydown. You or the seller pays discount points at closing to reduce your interest rate for the life of the loan. Temporary buydown, also known as a 2-to-1 buydown, is where the interest rate is reduced for the first 1 to 2 years and then adjusts to the full rate. This is a seller cost that must be written into the contract. Rate buydowns will help reduce your initial monthly payments, making homeownership more affordable in the first few years. In a buyer's market, these concessions are a reasonable request, but when sellers are getting multiple offers, it is harder to get them to agree to concessions such as these. Buying a home is one of the biggest financial decisions you'll ever make, and whether you're financing your first home, upgrading to a second home, or even paying cash, understanding your mortgage options is key to getting the best deal and setting yourself up for long-term success. We've covered the most common types of mortgages, from conventional loans to VA, FHA, and jumbo loans, as well as special financing options that can help buyers in different situations. The right mortgage depends on factors like your credit score, down payment, long-term goals, and whether you're looking for lower upfront costs or lower monthly payments over time. But here's the most important takeaway. Your mortgage isn't just about getting approved. It's about getting the best terms for your financial future. That's why working with a knowledgeable lender and real estate agent can make all the difference. If you're planning to buy in the Lake Travis area, I'd love to help guide you through the process, answer your questions, and connect you with some of the best lenders in the business. Drop a comment below with your questions, and don't forget to like, subscribe, and hit that bell icon so you never miss a video about buying and living in Lake Travis. I'm Ellen Steele, a local realtor. Lake Travis is waiting for you.